The first half of 2022 was the worst start to a year since 1970. Markets were hit with several bouts of volatility in the second quarter, which ended with declines across the board for both equity and bond markets. The S&P 500 officially entered bear market territory, down 20% from the highs at the beginning of the year. Both Barclays bond indices were down between 5 and 10%. Some of the higher flying, risky investments experienced even more severe drawdowns. The tech-heavy NASDAQ index fell over 25% as growth companies underperformed value-oriented stocks. Cloud computing companies as a group fell more than 36%, while Bitcoin was down over 58% from the start of the year. Valuations, as measured by the forward price-to-earnings ratio, declined considerably alongside the broad market downturn. The forward PE ratio now sits at about 15.8 times, below the 16.6 times 25-year average level, and down from about 22 times at the start of the year. The Consumer Price Index, which measures inflation by calculating price changes on a basket of various goods and services, remains at 40-year highs. In fact, the May inflation report, which was released on June 10th, showed an acceleration in price increases to about 8.6%. This ignited several weeks of market volatility and concern from monetary policy officials that inflation was getting out of control. The Federal Reserve met on June 15th and instituted a more aggressive 75 basis point rate hike in an effort to rein in inflation. Many economists now fear that the Fed's actions may actually lead to a recession. We have since uncovered some evidence that growth is beginning to stall. After rising dramatically through 2020 and 2021, prices for semiconductors, shipping, and fertilizer appear to have peaked. Inventories are on the rise as many companies ordered more than they needed at the height of the supply chain snarls. As these issues slowly resolve, many companies are sitting with more inventory than they anticipated. We could see this lead to discounting if consumer appetites wane. The labor market remains fairly tight, with job openings over 11 million, although wage growth has begun to plateau. The savings that were built up during the pandemic from stimulus checks and forced reduction in spending on travel and entertainment have begun to dwindle. The personal savings rate ended the quarter at 5.6%, below the average level over the last 10 years and far below the record high set during the pandemic. The University of Michigan Consumer Sentiment Survey hit a record low, indicating that consumers generally have a pessimistic outlook as many are feeling squeezed by surging inflation. We are also beginning to see evidence that the white-hot housing market might be rolling over. Housing starts declined sharply at the latest reading after rising steadily post-pandemic. Mortgage rates have risen sharply, topping 6% before finishing the quarter around 5.7%. These higher rates will likely put pressure on housing prices as affordability is impacted. Following June's 75 basis point increase in the benchmark target rate, the Fed will meet again at the end of July and is predicted to hike rates by another 50 to 75 basis points. The Fed has made it clear that their priority is maintaining price stability, even if it means a recession in the near term. The resilience of the labor market thus far has given the Fed room for more aggressive rate hikes. The Fed is also planning to reduce the size of its balance sheet, a process known as quantitative tightening. The reduction will start at a rate of about $47.5 billion per month and is projected to scale up to $95 billion per month in the future. Many questions remain about the impact of this monetary tightening process on financial markets. The Fed has vowed to remain data dependent. How quickly inflation comes down will dictate how aggressive the Fed will need to be with its rate hikes and quantitative tightening. The Fed is aiming for a soft landing scenario in which inflation comes down without causing a recession, although many are now anticipating we will hit a recession in the near term.